Hey everyone, and welcome to Cash Out. This is episode 4. Cash Out is my weekly TV recap show where I talk about what happened in the stock market last week and look forward into the week to come. However, next week, next Friday, is New Year's Day. And by the way, if you are new to trading and investing, the stock market will be closed on New Year's Day. So instead of just looking into the next week, I thought I would do a little bit of a recap of 2020 and look forward into 2021. Before we get started in any sort of recap scenario, it's important to talk about how really at the end of the day, everyone's kind of just guessing. And I want to make a note of this to all the new investors out there. If you're a new investor and you're going on TikTok or Twitter or Instagram and you're following all these other day traders or stock guys, stock gurus, and they come out with these predictions about what they think will happen on Monday or what they think will happen next week or what they think will happen next month or what they think will happen with a sector or a company. They're really just guessing. There's no way to know. That's the reality. If they guess and they guess correctly, you're going to think they're a genius. If they guess and they guess incorrectly, you're going to think they're an idiot. There's no way to know for sure, which is why I don't really like doing these kinds of prediction videos, but I've got 20 minutes to fill, so I'm going to do one anyway. If I'm right, cool. If I'm wrong, whatever. Don't think I'm some sort of super mega genius if I happen to guess what I think will happen comes true. They're just guesses. There's no way to know. Now, over time, you can say, well, I think the stock market will go up because historically that's what the stock market does. So, of course, if you're just saying, hey, I think it's going to go up, it probably will. But it's the smaller term stuff. Oh, Monday, the stock market's going to get hammered on Monday. Oh, you're just guessing. So 2020 for me was an interesting year. I've talked about this in other cash out videos, so I don't want to dwell too much on the past. But if you follow me on TikTok or anything or here on YouTube, you know that I'm most often a swing trader. That means I buy and hold for more than one day, right? Day trading is strictly in and out of a position on the same day. Win, lose, or draw, you sell before the market closes at 4 and you start over the next day. Swing trading is a little bit different. Swing trading is that you buy and you sell. Maybe you buy on the dip and you wait for it to recover, or you notice a trend of momentum and the stock is moving higher, you buy high and sell higher. I know that seems counterintuitive, right? We always hear about like buy low, sell high. Buy high, sell higher is momentum investing. You're noticing the trend, the charts, the news, everything is indicating to you that this stock is a runaway train. You buy it down here and ride that wave up a little bit. So that's why I kind of like sometimes buy high, sell higher. That's usually what I do. I swing trade. However, these last couple of years, the markets have been so volatile, I haven't really felt like holding these positions. Right? I didn't feel like I trusted the markets, the political landscape, coronavirus, the news that was just coming out every single day seemed to be, oh, it's no big deal. Oh, no, it's terrible. Oh, this is going to be okay. Oh, no, wait, and it was just, there was always some sort of big breaking news story in relation to COVID that made me think, I don't really trust the way this market is going. It's very volatile. And one of the things I always talk about on TikTok is to have a plan and to stick to your plan, but also to have many plans available. A lot of new traders don't do that. A lot of new traders find something that works for them and they think, hey, this is great. I really like this kind of style or this kind of method, and that's just what I'm going to do. Okay, but what happens when that doesn't work for you any longer? Which is going to happen. Markets change, news changes, sectors change, methods change, strategies change. Stuff just sometimes works great for a couple of years and then doesn't work great. What are you going to do then? How do you adjust? And that's why it's important to have many different strategies at the ready. For me, that was that I was a swing trader for basically the first 8 years of my career. I've been trading for 10 years. For the first 8 years or so, I was predominantly a swing trader. That doesn't mean that I wouldn't make day trades. It just means that I would say probably maybe 70% of my trades were swing trades. This year it has reversed dramatically, or in the last couple of years, to probably 80% day trades and 20% swing trades. And that doesn't count, by the way, my long-term investments, which I've been holding for the last 4 years and will probably continue to add to and hold for the next 20 years. I'm only talking about the trades that I've been making. It's really reversed. It's a lot of day trades and a lot of very short swing trades, a couple days. I don't really like to hold too long unless unless my research, I guess, tells me otherwise. Moving into 2021, what I think will happen is that the markets will maybe level out. We've got the vaccine, we've got Joe Biden as the president-elect now, or the president, depending on when you watch this video. He's calm, he's neutral. Maybe you like him, maybe you don't, but you can say there's one thing about him which is not like Trump, which is Trump is a wild card, and maybe that's what you liked about Trump. Okay. Maybe you liked his tweets, maybe you liked that he played by his own rules, he didn't really give a shit what anyone else thought. Okay. But Wall Street reacts to that. Wall Street likes calm, neutral, level. They don't like unpredictable, they don't like wild cards, they don't like sporadic. Wall Street likes calm and neutral. They also like finality. That's why in the lead up to this election, markets were all over the map. And when the announcement had been made and the Electoral College, okay, good, it's over. It's done. Now here's what we have. It's the same with lawsuits. It's the same with these class action things. You'll hear about it from time to time. Luckin Coffee, I think I mentioned in last week's show, Luckin Coffee, the stock exploded from around the $4 range up to, I think, maybe 10 or 11, simply because there's finality. They said, we're going to pay $180 million for the fraud scandal that we caused. Good. And this is what Wall Street, you would say, wow, 180 million, that sucks. Oh, fraud, that's bad. But the stock skyrockets because that's what Wall Street likes. It's done. It's old. It's an old story, and we're moving forward now. With Joe Biden, who's going to be much more calm and level-headed than Trump, I imagine that the stock market also will be calm and a little bit more level-headed. It doesn't mean that volatility is going away, because people made a lot of money from this volatility. And when people start making money, they're okay with it, right? So, okay, hey, if these market swings are the new normal, great for us because we're going to make tons of money. Then it'll probably continue. I imagine it will. I don't think volatility is going to cease to exist. I just think volatility might tamper down a little bit, like when you're making espresso and you just use that tamper to get the coffee down. I think it's just going to quiet down a little bit. I also would imagine that because of Joe Biden's very bold stance on climate change, that will help create lots of new jobs, right? Solar panels, electric charging, electric vehicles. I also imagine that if he does move towards legalizing cannabis nationwide, as so many states already have, that'll create lots of jobs. We'll be able to make a lot of money from the taxes that'll help, hopefully, as well. And infrastructure. He's looking to fix. Our roads are crumbling, our schools are crumbling. There's mold growing on the ceilings in classrooms. These buildings are old, they're decrepit, they're falling apart. The bridges are in bad shape. We can retrofit some very old buildings with solar panels potentially. So, that's a climate change and an infrastructure thing. So I imagine those sectors will do very, very well. If you want to talk more about COVID as a whole, I think it's still going to be around. If you watch the news and you hear what the scientists are talking about when it comes to the vaccinations, first of all, the most important people are going to get it now, right? The doctors, the scientists, the nurses, the elderly, and most everyone else will get it. They say anywhere from late summer to early fall of next year. So that could be a while. It means that we're still going to be wearing our masks. I think we're still going to be wearing our masks for quite a while. I think a lot of companies are still going to be feeling the impact of this. Maybe sports will return, maybe not. So there's a lot of stuff that's still going to be impacted from this, including travel, including cruise lines, airlines, live events will still be, casinos potentially could still have some pain to go. It doesn't mean, though, that at a certain point we might want to start thinking of, hey, maybe I can start putting in a little bit of money in some of these stocks that have been severely impacted by COVID, because things maybe at that point, whenever that is, might start to improve. Does that mean you should just go and buy the cruise lines now? Well, you could. If you're planning on being a long-term, super long-term investor, it doesn't really matter when you buy. However, if you think there's more pain and suffering to go, and you think that the cruises and the airlines, the casinos and the live event industries or stocks or sectors might continue to get pummeled in 2021, you might want to wait for a better opportunity to buy. Nobody really knows. So one method you might have is to kind of scale in. I always like that scale in approach. Whenever someone says to me, should I buy now or should I wait? The answer is, hey, why not do both, right? Let's say you want 100 shares of a company. You could buy 25 right now. Month or two down the road, if it's dropped a little, buy a little more. A couple months go by, some really bad news comes out, it plummets, buy a little more. That way, when things do recover, you can say, hey, I might not have gotten the 100 shares that I wanted, but I do still have some, so I did get 25 shares, and that's when things returned. Or I did get 50 shares, and that's when things returned. The one risk you have, by the way, is adding to positions as a company is dropping lower and lower and lower. What if that company goes bankrupt? What if they close down? What if they have such mounting debt that the stock just continues to drop and that sector never recovers? That is a risk that you have with this. The last thing I would like to talk about when it comes to 2024 is how the work from home landscape is probably going to change. I don't know the impact that this will have on commercial real estate, right? Especially in big cities where there are tons of office spaces full of hundreds and thousands of employees. That might be changing. I have friends who live in San Francisco who the offices are saying, hey, we're just never going to come back. Some people are essential to the office, a very small group, but the majority of you can really do your job from anywhere. You know, isn't that funny how we always used to say, no, you need to come in and you need to be in the office. But as soon as the offices and the company started realizing how much money they were actually spending on these buildings and this office space and these huge leases for 3 floors in a building that costs, however much per month. And when they realized, hey, people are still productive, but we're spending all this money on renting an office and we don't actually need it anymore. Oh, all of a sudden, again, when money is involved, they understand, they get it. So they say, hey, maybe we can downsize our office from 3 floors to house 10,000 to 5,000, 1,000 employees to a very small, close-knit office where we can have people come in if needed, but really because of Zoom, right, because of these apps, these work from home, Slack and stuff like that, people are able to work from home or anywhere. So I foresee this trend probably continuing. There will be a return, right? There will be a return to the offices, I think. But I do see this being a trend that continues. So then if we're able to work from anywhere, what stocks might benefit from that? Travel, Airbnb, stocks like that allow you to go anywhere, do anything. If you're relocating every couple of months or whatever to a different place, you might not have a car, so you might be relying on Uber and Lyft and stuff like that. It's just the way of thinking. So that's my prediction for 2021. I think certain stocks will take a while, live events, concerts, travel, casinos, to recover. Other stocks will continue to do well. And by the way, the funny thing is, every time some bit of news comes out, we're so reactive. The stock market is so reactive. So they say, oh, there's a vaccine, people are going to start going back to work. And the work from home stocks plummet, as if this is going to, right, as if it's suddenly magically all these companies are going to go, we changed your mind, you can come back now. We don't mind spending thousands of dollars per month on office space when we don't really need you. We can save tons of money, but come back. That's not going to happen. I think Stock Santa thinks that eventually more and more people will be working remotely. More and more people will be working from home. So the work from home stocks might pull back on these days, right, where there's a vaccine, yay! Oh, all the work from home, stuff like Peloton is plummeting because everyone's going to go back to the gym. Maybe people like going to the gym, it's a social thing, so maybe a stock like Peloton might get hurt. Maybe not though, because if you're paying attention to the Peloton news, for example, they just bought Precor, which is one of the biggest gym manufacturing companies out there. Precor, every piece of equipment in every gym you go to, whether it's Gold's or whatever, Crunch, they have Precor stuff. Precor is the standard, and Peloton just bought them. So if Peloton suspects that their sales could be slowing on the bikes and the at-home stuff because COVID is over, they've now branched out into the gyms. And if people do get vaccinated and go back to fitness and go back to gyms, maybe we'll be seeing Peloton bikes at every gym. And that could be a selling point or a selling feature. Hey, you might even see gyms do Peloton classes and not have an in-person trainer. Or, hey, if we have spin class 3 times a day with an instructor, maybe the other times of the day you can just walk into the spin room, pull up a Peloton class at your gym and bring a couple friends in. Who knows what they've got planned? Anyway, that's a little bit of I went off topic. So I think we have recapped 2020. Was wild. It was volatile. It was my best year as a trader ever. So moving forward, I will definitely be implementing probably some more day trades because that was incredibly lucrative for me. Although if we do have a consistent uptrend, I will probably be more comfortable holding for the long term, right? Making a short swing trade, right, where I can hold for 3 weeks or 2 months or whatever, because the upward trend is there, and then the support and the resistance lines are indicating that it's either not going to break out to the downside or it's keeping on with its trend of breaking out higher and higher over the course of several weeks. Then I will of course hold. One thing I want to talk about when it comes to swing trading is I tend to use a little less money on my swing trades than my day trades. Reason being, I'm tying up those funds for a longer period of time. So if I'm in a point where I need income coming in to pay for my bills, my groceries, my condo fees, my car, my insurance, I tend to put a little bit more money because I have the experience and the knowledge and the confidence to do it with the day trades. If it starts to go south, I'll get out because I need that money. So I will be putting in more on the riskier day trades and a little bit less on the stuff that I'm tying up for 3 weeks or a month or 2 months. So I wanted to talk about two things. Now we're getting to the point of the show where I go into the TikTok questions. I don't really know how to wear these hats. They just like flop and fold and look weird. I got two questions on TikTok about stop losses and the pattern day trading rule. So I want to go into those a little bit. Somebody asked me on TikTok about stop loss, and if you follow me on TikTok, you know that I try to do video responses for everything where I can fit it in under a minute and get the answer across. Sometimes you can't do that. So stop losses are one where I'll do like a 60-second video and then I'll get like some trolls in the comment going like, "You forgot to mention this, you idiot." And it's like, well, I didn't forget. It's just, if I do a 3-part video series on it and you only watch the one video or the second video, you know what I mean? That's why TikTok can be a little annoying. And that's why I like coming on YouTube and having this cash out show where I can go into more in depth. So stop losses, I personally never use. The reason I never use stop losses is because I'm an active trader. I'm always sitting at my desk. I'm always sitting at my screen. I've always got my cell phone handy. Even after the markets close, I can pull up a stock and I can look at something. I can pull up and go, oh, this company is having bad news. Maybe I want to get out. Stop losses are designed in theory to help you mitigate loss. It's risk management. I think a lot of people think, I want to get into trading and investing, but I don't really want to spend too much time doing it. I'll just automate it. I'll let the computer do all the hard. I'll buy the stock and then I'll say, hey, if this stock drops 5% or 7% or 10% or $1 or $3, you can set it up by dollar or percentage. It'll do the hard work for me. It'll sell the stock. That way I don't have to be paying attention too much. I don't like doing that because it means that you're not, A, looking at the news and learning and reading and understanding why these stocks might be dropping. B, you might be getting out of a stock that's unfairly getting punished just because of broader economic news. There's just a lot going on. And C, and most importantly, stop losses aren't a guarantee. They don't guarantee that the stock will sell in time. Here's what I'm talking about. And by the way, stop losses also don't work after hours. So when the stock market has closed, I'll put in a video on my screen showing you how to set up all this stuff. If you set up a stop loss, it is business hours. It is 9:30 to 4. They don't trigger before pre-market. They don't trigger after the market closes during the after hours. If you set up a stop loss and then the stock market closes at 4 and you walk away and you forget all about it, something might happen after hours that brings that stock down. Maybe it's earnings, maybe it's broader economic news, maybe it's a competitor that had really bad earnings and the stock drops. All stocks drop because the one sector, let's say automotive, this automotive company comes out and says, oh my God, it's the worst quarter we've ever had. And they drop 40%. All the other automotive companies, including yours over here, are going to drop 20% in theory, because they're all going, oh my God, the big one had a really bad earnings. That means all the little ones will too. Everyone's panicking, everyone's jumping out. You can buy and trade and sell stocks after hours. It's just that you want to set your order to extended, which I'll put in right here. Put it in extended. That way your order goes through after the market is closed. If you just put in day, and then you set your order, well, the market's already closed. So day, the computer, the system, the software will interpret that as the following day, not pre-market, 9:30. So what can end up happening with these stop losses is when you put in a stop loss and say, if it goes down 7%, sell it, and then you go about your business and you forget all about your stock because you're not fully invested in it. Here's the scenario. You go to the office the next morning, or you are doing your full-time job, whatever it may be, and 10 o'clock comes around, you pull out your phone and you look and you see that your stock that was $10 yesterday is $8 today, and you're like, thank God for my stop loss. Well, that news came out after hours, right? The previous day, that company had really bad earnings, or another company had really bad earnings, and all the stocks dropped. Your 5% stop loss doesn't trigger, because the orders come in so quick, so fast, that the stock drops too quickly for your order to trigger. There's no buys, there's no sells, there's nothing at that level, and your order does not trigger. You're stuck because you weren't paying attention. So now you're sitting there going, oh my God, I bought it at 10 and it's 8 now and I'm down $200 or $2,000, depending on how many shares you buy. You're sitting on a humongous loss now because you thought your stop loss would trigger after hours, but it doesn't. That's why it's important when you're getting into this to be really active about this, to really be paying attention to what's going on. If you don't, you could get hurt. All right, next thing I want to talk about is the pattern day trading rule. I'm going to edit this video as a standalone as well, because I get a lot of questions about the pattern day trading rule and how it affects people. So here's the pattern day trading rule in a nutshell. I guess it's the Securities and Exchange Commission puts this rule in place to protect you. This pattern day trading rule exists to protect you. If you are new to day trading, as so many people are because of COVID, and they're all from home, and they're going on TikTok, and they're going on Instagram, and they're seeing people with Lamborghinis going, I'm a day trader, and buy my course, and they go, I want to be a day trader, and so they start day trading. Those people are very inexperienced. And so this pattern day trading rule exists to prevent you. It's kind of like a protection. They're just protecting you. They just don't want you to get wiped out. And so the way that the pattern day trading rule works is that if you are trading on a margin account, that means you're using borrowed money, the bank's money, to make your trades. When I make a trade on a margin account, that money, I sell 10 shares of ABC Corp, that money is immediately returned to my account. That's margin. I can use that money immediately to make more trades. If I have over $25,000 in my margin account, I can make as many day trades as I want. Reason being, I guess they assume, hey, you've got a lot of money, it's okay. If you have under 25, I guess the assumption is, oh man, this guy doesn't have very much money. Wouldn't it suck if he lost everything day trading? Let's set up a rule here to protect him, to mitigate some of the loss for him, because new traders tend to be kind of dumb. So the way it works is if you have under 25,000 in your margin account, and you make more than 4 trades in a rolling 5-day business period, right? So Thursday, Friday, Monday, Tuesday, Wednesday, right? It covers the week. It's business. It's just, it's not Monday to Friday. It's a rolling 5-day period. So if you make more than 4 day trades in a rolling 5-day period, you get flagged if you have under 25,000. And then you are prohibited from day trading going forward, because they're trying to prevent you from getting completely wiped out. If you have more than 25,000 in your margin account, you can day trade every day, all the time. Another way around the pattern day trading rule is to not have a margin account. If you have a cash account, you can make as many day trades as you want. There's just one problem. Some of those the funds that you're using when you're buying 10 shares of company A, when you sell those 10 shares of company A, the money isn't returned automatically into your account like it is with margin. You have to wait. That settlement period is usually 2 days. So you have to wait 2 days before you can use that money again. Money won't even be in your account. It'll show up 2 days later, because that's the settlement process. This isn't the worst thing in the world. if you're not using your full, say, like let's say you have 18,000 in the account, if you're using your full 18,000 on every single trade you make, then you can only make one trade every couple of days because you have to wait for settlement. If you have 18,000 but you're dividing it up, I'm going to put 1,000 here, 1,000 there, you can make as many day trades in theory as you want because you're not tying up all of your funds. So even though you're making a day trade here and a day trade there, you've still got 15,000 or 12,000 or 10,000 sitting in cash. So that's one of the ways around the pattern day trading rule. Another, I believe, is to have multiple accounts at different. You can have Robinhood, you can have Webull, you can have Ameritrade, and then you can do that as well if you want. But it's not really necessary unless you're putting in all of your money, right? If you're putting in all of your money on every single trade that you make, then of course you are limited. If you have 18,000 in cash, but you're not nearly using all of that to make your trades, you'll probably never run into this problem. So I think we have covered it. Anyway, I think that settles that. That is the end. That's the wrap up. Last show of Cash Out for 2020. Next time I see you, it'll be 2021. So if this is the last you see of me because you, for some reason, don't follow me on TikTok, but still, have a happy new year and I'll see you in 2021.